This is TreppWire Week in Review for week ending April 8th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with our experts Lonnie Henry, head of CRE and advisory services, and Andrew Jacobs, head of structured finance. This week, the talk was about the meeting minutes from the Federal Reserve, which revealed a plan to shrink the bond portfolio at a rate of $95 billion a month, and signaled one or more 50 basis point interest rate hikes to curb inflation. And markets reacted with stock indices dropping and bond yields rising. On the data front, factory orders fell in February, and jobless claims and unemployment numbers highlighted a tight labor market. Lonnie, what was it that you were looking at?
Yeah, I think it's interesting, Martha. The Fed, the notes and the Fed just being in the news cycle over the week. I think this is probably the third or fourth week in a row we've kind of let off with the Federal Reserve. I think they're intending to be on top of the news cycle. And so here's a couple bullet points. Stocks were down again Thursday. Just the comments from the Federal Reserve point to aggressive monetary policy tightening. We have some comments from a few folks associated with that I'll get to here in just a second. But, effectively, what's new to the bond market this week is the Fed's really close to beginning its balance sheet reduction. The $95 billion per month is a pretty big number. If you annualize that, we're talking over $1 trillion in a year. It means less money moving into Treasury bonds, lowering bond prices and lifting their yields. 10-year Treasury has risen to 2.66 from 2.41 at Monday's close. And then the St. Louis Federal Reserve President, James Bullard, he had a speech this week where he said the current Fed policy is too low by 300 basis points. So as we're talking about 25 basis point increases or 50 basis point increases, Mr. Bullard comes out and says they're 300 basis points too low. He believes the benchmark lending rate must rise above 3%, relatively high, as the markets have been expecting the Fed to lift rates to around 2.75. And he says he thinks the economy can withstand this aggressive tightening of interest rates. His comments or quotes were, the labor markets are robust and likely to improve further in 22. Real GDP will continue to grow at a slower but robust 2.8% in 2022, despite a relatively weak first quarter reading due to the Omicron variant and Russia-Ukraine war. So he was giving this talk to the University of Missouri. So I think it's really interesting on the Fed front. A few other just quick anecdotes. Initial jobless claims were 166,000, which was significantly better than the expected 200,000 and lower than the previous week's 170. So those were a few of the things that caught my eye on this week that I was keeping an eye on.
Yeah, could there be any more things happening this year? The interest rates, the war, the jobs, it's a crazy environment, and there's a lot of volatility. So with raising rates, I guess you have to take a look at, obviously it's a technical thing, but are the fundamentals still there? Is this an opportunity to buy? Is it not an opportunity to buy? It's very early to figure all that out, but it just seems like there's a wave of news every week about things that are directly affecting our markets.
Yeah, I know. I think it was about 4 weeks ago we were talking about before the Fed enacted the first 25 basis point increase. And, I made a comment to Manus on that episode of they've been talking about this for so long, it's time for them to actually do something. And, now the talk has been really ramped up. And so I think even this week, Powell has pretty much confirmed that a series of 50 basis point moves is coming. It's interesting. I think in the day and age that we live now, where people have instant access to these things like the meeting minutes, all these anecdotal comments from the different, stakeholders, they kind of move the market on the front end, trying to get that priced in so that when they actually make the move, the markets aren't shocked. So I think it's a new version in 2022 compared to what we might have seen 10 or 15 years ago, where this data wouldn't have been as widely disseminated in advance of their moves. Now they strategically kind of plant this information in the marketplace so that it doesn't shock the markets when they actually take the action. One other thing, Martha, I didn't mention this on the front end, I've kind of championed our discussions on this a few months ago on the 1031 exchange. I did see a nugget this week that in President Biden's recently released budget proposal, the 1031 is back on the chopping block. So I know we had done some research and actually talked about it on one of the previous pods around, that the 1031 for real estate is the last remaining exchange that's been permitted. We thought that they were maybe going to abolish it when Biden was elected. It survived, but it seems like it's back on the chopping block. So For those that don't know, 1031 exchange allows you as a commercial property owner to take your property upon sale and take the gains that you receive at the time of that sale and roll it into a new like type exchange or a new property. There are some caveats in terms of number of days that you have to identify the property that you want to roll it into, and the number of days that you have to actually execute on that next sale. But you effectively get to take all of your proceeds, which would be subject to capital gains, roll it into the new deal, deferring those capital gains. And there's some really big downstream implications because all of that money helps that local economy. It creates new sales tax opportunities, new property tax opportunities, et cetera. So we can maybe keep an eye on this for some future discussions if this continues to stay out there in his most recent proposed budget.
And this week, you've probably noticed Manis is not here. He's on vacation. And in fact, he was at the Masters in Augusta where the Tiger, has returned.
When we're recording this, we just looked and he's 3 back from the leader. I mean, I gave him some notes on his swing. It doesn't look like he took them into account. I think, I was expecting him to be leading at this point, but we'll see how he goes into the weekend.
I'm actually hoping to see Manis on TV with the same colored shirt that Tiger Woods has on today. So if Manis is out there, and I don't know what we're calling that, magenta or fuchsia or whatever, but I'd love to see Manis rocking one of those mock Nike turtlenecks in the bright pinkish purple.
I don't know if he has a color like that. I don't know if I've ever seen that. We'll have to hook him up with one of those. Yeah, we spent a lot of time last week talking about interest rates and actually had our expert, Matt Anderson, break it down for us. If you missed that episode last week, it's worth a listen where we covered it in some detail. But we're going to dive into the CMBS section here first with special servicing. We covered delinquencies last week. We gave the numbers and detailed that in some degree. So we're going to skip that this week and go right into some of the other areas like special servicing.
Yeah, I mean, special servicing bucket fell 42 basis points in March. It's down to 5.66%. And a year ago, it was 9.42%. So, the biggest areas of improvement were in lodging and retail. For example, the lodging rate fell a full percentage down to 10.88%. And retail as well fell a full percentage, 102 basis points to 10.9%. And also, just in terms of how many loans are on the watch list, it went down by 37 basis points to around a quarter, 25.52%. So the 6th consecutive month of declines. So it's a positive story. In terms of loans that were added to the special servicing list, there was the largest one was a $237 million Walden Galleria. In the commentary, it was noted that the loan received a modification in April 2020 due to COVID, and it was added to the watch list as its DSCR fell to 0.68x below the 75x threshold. The decrease was reportedly caused by a decline in occupancy as well as several current tenants receiving a rent reduction or referral, leading to a decline in effective gross income. So it's an overall positive story, I think, but there are still things it's an idiosyncratic asset class, of course, and there's still properties going into this special servicing list. The commentary also indicated that there's ongoing work on COVID-related rent relief for some of the tenants, and several tenants have left at lease expiration. So the loan was underwritten with a DSCR of 1.14x. It slid to below 1x most recently in 2016 and 2017. But it was reported at 1.07x in 2021. So occupancy was 97% in the first quarter of last year. In early 2007, the collateral was appraised to $116 million, and the value was cut several times over the loan's life. The newest released data shows a value of just $45 million back in June 2021, and the loan is REO.
Yeah, it seems like every month we can find a mall property or something of this nature that we can highlight. I mean, the numbers just don't look good. When it says it was added to the watch list as net cash flow debt service coverage falls to 0.75 or below the 0.75 threshold, that's just not looking really good. Reported 2021 debt service of 1.07 at 97% occupancy. It's really tough. That's just not good. If you're at 97% occupancy, you're hoping for a much healthier debt service coverage ratio. So, that's maybe a little bit of some bad news, but it seems like on the whole, things are improving. And I think that ties into what we talked about last week on the delinquency, where we're starting to see improvement pretty much across all asset classes.
And we also released our March loss report. So that was sent out, I believe, today. And we had some nuggets in there, Andrew, that I think you wanted to cover.
For sure. So in March, there was about 190 million across 13 loans that were resolved with 85 million in losses, carrying an average loss severity of 44.72% for the month. So this was a significant decrease in loan loss volume from the month prior. More than half of the resolved loans backed lodging properties. So the 12-month average disposition balance moved to 327 million roughly, while the 12-month moving average loss severity stood at 59.5%, slightly down from 60% seen in February. The largest loan to take on a loss this month was the 92 million University Mall. The loan made up 79.38% of the remaining collateral behind LDCMT 2007 C3. So the property is Vermont's largest enclosed shopping mall. In Vermont, I would hope it's enclosed. And it's located just south of the University of Vermont. The collateral consists of 610,000 square foot, including ground lease space. It's a regional mall located in South Burlington, Vermont. And it's on a fairly large space, 52 acres roughly. It's anchored by a Sears, Kohl's, JCPenney, Target. You know, this mall, for those with sharp ears, it has been the subject of a lot of TreppWire articles and mentions in the podcast in the past.
I don't know if you guys saw the news of that startup Fast that closed down this week. So they raised $120 million to produce, you know, some nominal amount of revenue with 500 employees. It makes me think about this at the University Mall. I mean, imagine going to a pitch deck where you're saying our anchor tenants are Sears, Kohl's, JCPenney, maybe a little smoke and mirrors there. These 2007 deals, they were able to secure really large financing deals with tenants that probably just are not viable in today's economy. You know, there's some similarities or parallels there to what we're seeing in some of this VC startup marketplace.
And if we need to look for these numbers broken down by property type and loan size, check it out in the next few days. That'll be coming out from TreppWire. So if you're interested in that, give us a shout at podcast@trepp.com. And the last, to round out our CMBS segment here, is we're going to talk about issuance and what that has looked like in the first quarter.
Right. So domestic private label CMBS issuance was up actually 88% in the first quarter to 29 billion, but driven pretty significantly by single borrower transactions. You know, it's not a totally fair comparison. Last year, the first quarter was a little light as people were kind of getting back into the market and restarting after all the uncertainty around coronavirus. But issuance of conduit was still a little low. Volume did go up by 50%, but it's to 9 billion compared to a year ago. And it, you know, compares to 16.67 billion of issuance in the fourth quarter of 2019 before the pandemic. So, you know, up a little bit post recovery, but down from pre-pandemic levels. Just this week, there were a few issuances. There was a conduit deal that came out that was, you know, roughly $700 billion, a little under, and there were 2 SFR deals and a European large loan deal as well.
So let's break them down by property type, and we're going to start with retail, and we're going to start with a story that's, I think, some crabgrass. I think the crabbiest I've seen in some time, where Europe's largest mall operator is closing up shop in the U.S.
So is crabgrass? Is that just crabgrass with an attitude?
I think it is, actually. I think it is.
Or
it walks
resistant to the weed
sideways.
killer. Yeah, walk side. Oh, that's even better. So we have Unibel, Rodamco, Westfield, SE. Say that 3 times fast. Is bracing for potentially sizable loss. Paid about $14 billion 4 years ago for some of the country's top performing malls. Unibail wants to shed most of its U.S. properties by the end of 2023. So this narrative we've heard and seen for this property sector, it's not unique to just this operator, but the chief executive told investors last week a timeline that some analysts described as aggressive. The disposition by 2023 appeared to be aggressive, Unibail valued the American portfolio at about 13.2 billion at the end of last year. They believe they can deleverage those properties and sell off at about a 30% discount when compared to the 2021 valuations, although they haven't specifically said how much they think they can get for the properties. Green Street, the commercial real estate analytics firm, estimates the company's U.S. assets are worth closer to 10.5 billion pounds. Unibel likely will have a hard time finding buyers by next year and almost certainly won't get what it paid for. So I would say, while the executives are spinning this as a repositioning and they think they're going to have to take a 30% haircut, the market may view this slightly less optimistic when it comes time for them to actually transact.
Just looking at it from a CMBS perspective, there's 45 loans in the CMBS space that have exposure to this company. They spread across 27 deals, so roughly 3.4 billion of loan balance. It's a pretty significant amount, and give us a shout if you want more detail about that.
And we've talked about the Chicago area, specifically the Magnificent Mile, which I think last time we talked about it, we said it was not so magnificent, but Water Tower Place, its owners giving up the property.
Yeah, so I think since we haven't come up with a clever name for Magnificent Mile, we just have to spell it in all lowercase letters. That way it doesn't appear to be that magnificent. So, some more bad news here. The Water Tower Place gives up the properties, as we've called that jingle mail in the past. So they lost their retail anchor, Macy's. The lender MetLife is going to take over the iconic mall at the Magnificent Mile, which has been plagued by vacancies during the pandemic. Brookfield said is turning over the vertical mall to its lender, a unit of the New York-based insurer. Action indicates Brookfield believes the mall is worth less than the estimated $300 million in debt on the property. Macy's closed in 2021. Numerous other retailers obviously closed for good as well. So, I think this highlights the importance of some of those anchor properties and the foot traffic that they bring in. Once your anchors leave, we've actually highlighted on previous pods and done some outbound content on co-tenancy clauses and some of the things that those anchors bring, vibrancy to the underlying collateral. When Macy's or these others close, some of those inline spaces can't survive. So Food Life Food Hall closed down, Mighty Nice Bar and Grill closed, Gap and Banana Republic. So I think this is just another example of, an immediate setback for that CRE marketplace. This was once a very nice, chic mall, and unfortunately, it just hasn't been able to persevere through the pandemic.
Let me just say that, I have some Banana Republic underwears that, there's no way that classifies as chic. It's not possible.
Right now, I'm speechless. I think, I'm not really sure what to say to that, except maybe we'll move on to the next story. I've got two more crabby stories before we get some positive news here. We have a Gold's Gym that is being sold, and it is tied to CMBS. But I got to say, gymnasiums and clubs that have anything to do with working out were severely hurt during the pandemic. And so obviously that's a challenge. And this particular property has the Gold's Gym and a cinema. So it's a bit of a double whammy.
Yeah, so Cushman and Wakefield reported on this one. It says Tollimer's Capital Markets Group arranged the sale of the Gold Gym Plaza in Richmond. They acquired the property for $13 million. Catherine Spangler of Cushman and Wakefield was the broker on the deal. Tollimer represented the sellers, West Tower LLC and Sugar Oak Investments in the transaction. It's at 8900 West Broad Street. It's about 125,000 square foot spread across 5 buildings. And as you mentioned, Martha, fully leased and co-anchored by Gold's Gym and Regal Cinemas. They both occupied the space for some time. It looks like 40 and 19 years respectively. The 44,000 square foot box anchored by Regal and adjacent parking lot are subject to the ground lease. So as you mentioned, this does have a CMBS tie-in. We actually have the detailed information on this particular asset in the data set. And I think this just speaks to your point of, they felt almost like hotels, the immediate brunt of the pandemic. People weren't allowed to go to the gym. There's not a plethora of alternative uses for those properties that people can't come there. And we're seeing that reflected in this really low sales price at $13 million.
A mall in the area of Shreveport, Louisiana, has been placed on the market.
Yeah, so Rialto Capital Advisors, special servicer, has been handling this. It's about a $40 million loan. They've been working on this asset for nearly 2 years. I'm going to go ahead and butcher the name real quick just because I've actually done pretty well, I think, on the first few that I thought I might stumble on. So we'll see here. The Pierre Bossier Mall in Bossier City, I don't know why I have to get that weird accent, but it just comes with it, is the property in question. It's securitized through UBS Barclays Commercial Mortgage Trust, a 2012-C2 deal. It's been delinquent since last May and is now classified as in foreclosure. Continue to be owned by an affiliate of Brookfield Asset Management, which agreed to turn the property over in a deed in lieu of foreclosure. Newmark's national mall sales team, they must be busy right now, have been retained to sell the mall property. The most recent appraisal from last June was $10.5 million, down from $69.4 million when the property was securitized in 2012. Again, we've heard this story. They lost Sears, which was about 80,000 square foot of non-collateral space. And then in 2018, Virginia College, a for-profit school that had occupied about 59,000 square feet, also shuttered their doors. I think they actually did that nationwide, not just at this property. So, it's been hit with two of their largest tenants vacating, and this type of appraisal reduction is significant. Again, 69 million down to a current value of about 10.5.
Unless you think we've only got crabby news, we've got a positive story in the area of Union Square, which has had its share of negative stories in the past year or so.
Yeah, this is Union Square in San Francisco, and there's a store. It's Sugar. They signed a short-term lease for 20,000 square feet of empty retail space at 2 Stockton Street, taking over the spot formerly occupied by Forever 21, another retail chic store. The San Francisco Business Times reported it. It has 227 feet fronting Market and Stockton streets, and it's been vacant since late 2019. So it's a very visible corner location in downtown San Francisco. Just kind of the entrance to that area, Union Square. So it is positive. Maybe bring a little more vibrancy to the area.
Yeah, we've had a couple of these stories over the last month or so, and it seems like, from what I've seen online, investors are maybe looking at San Francisco as having hit rock bottom. Now, they still haven't cleaned up some of the issues that they have there, underlying some of the challenges that these retailers have faced. But I think they're getting back to a place where people feel long-term San Francisco is still a good opportunity. So I think this is hopefully, just another of many to come for that Union Square, location.
Let's go to industrial quickly. We have a couple of stories that were transactions that continue to demonstrate how industrial is performing well. The first one is Best Buy that has signed a big lease for distribution facility.
Yeah, so I think the headline here is that industrial is hot, which brings me back to a Snoop Dogg song that says, drop it like it's hot, drop it like it's hot. So we're going to drop it like it's hot. Best Buy signed a huge lease for a big distribution facility, 501,000 square feet of building 6 in the larger industrial park named Logistics Center in Eastvale, according to a report from Savills. It's located at 6251 Archibald Avenue in Riverside County. This is probably the hottest industrial market in the U.S., or one of them in the Inland Empire. So if you just Google Inland Empire, it's east of LA, and it's a really, really dynamic industrial marketplace right now. We have a couple of other stories here in the industrial market that we'll hit on. Rexford Industrial Realty have acquired 4 industrial assets in Southern California in an off-market transaction, about $82.7 million in total transaction cost. Properties the company purchased in March include 700 through 806 West 14th, 701 through 733 West Anaheim Street within LA's South Bay area. They also purchased 19900 Plummer Street within the San Fernando Valley, 6245 Providence Way in the Inland Empire we just mentioned, and 13711 Freeway Drive in the LA Mid-Counties region. In the first quarter, Rexford's been very busy. They completed a total of $458 million in new investments, 259 properties comprised of about 32 million in rentable square footage. They own 75% of all of the industrial space in LA, Long Beach, Anaheim, metropolitan statistical area. So they definitely have the market share there. And what's interesting is their current occupancy rate is nearly perfect at 99%. 86% of those acquisitions in 2021 were acquired through off-market or lightly marketed transaction. And this was thanks to a lack of competitive bidding for these acquisitions. Cap rates came in about 6%, which is double what their competitors were able to generate on similar transactions. So, as I'm going through this, I'm thinking to myself, I don't see where the upside is on these assets when you're buying them with in-place occupancy of 99%. But if you acquired them in off-market transaction at 6% cap rate when the market is 3%, you're doing pretty well at that point. And then the last story here on industrial, CBRE conducted a survey, and the takeaways are pretty interesting. They were focused on data centers. The sentiment from the folks surveyed were that the data center investments are going to continue to stay hot. They interviewed, I believe, about 115 respondents. 95% of them indicated they plan to increase their capital deployment into data centers in 2022, and not a single respondent planned to decrease their data center investment. So, it just is more good news on the front end of this. It says half of those surveys had less than 5% of their total holdings in data centers. 4 out of 5 wanted to increase that exposure above the 5% threshold. The one thing that maybe brings a little bit of trepidation or a little pause there is that, there are some ESG concerns on these assets as a whole. So because of the energy cost, because of the additional HVAC that's required and some of the other things that are part of the data center operations, they're maybe being looked at in a little bit lesser light from the ESG front. So you'll see Amazon, Google, Microsoft, et cetera, they're really setting themselves up with shorter term leases, leveraging their ability to keep up with the rapid development of new technology. So I think we've seen up to this point, these data centers have been built to suit with long-term leases in place, which really were advantageous to the developer. And what this story talks about is some of these tenants are now shifting the narrative and saying, we're only going to do short-term leases because what's required for a data center today is basically going to be obsolete into the future. And so we'll see if those lease covenants and rental rates, change that investor sentiment as they start to implement some of these shorter-term leases with these national large-scale tenants.
And then moving to office, there were 2 stories that were interesting on the topic of physical occupancy of offices. And one was a survey that was done, and it showed that New Yorkers plan to cut their time in the office by half.
Yeah, so New York City is second to San Francisco in its reduction of office time. Office occupancy is at just 36% still. New Yorkers who worked from home during the pandemic, they plan to cut their time in the office by around half. And, of course, they're going to be spending less money in the city as a result. It's a challenge, especially for companies that are trying to sell to those office workers. The average New York City office worker would slash spending in the city by around $6,700 per year. And that, down from an estimate of around 12.5 thousand before the pandemic. That's according to a professor from Stanford University. Not great news for retail, for restaurants in the area, things like that. That being said, if you're going to the office half the time, you still need office space. So, unless companies move to a model where you don't actually have an assigned desk or an assigned cubicle, so there should still be demand for office space in the city, at least in the short term.
It's interesting. We've talked about this in the past. Traditionally in CRE, occupancy has been measured in 2 ways. It's been measured, one from a physical perspective and one from an economic perspective. And what I mean by that is if you had a space with a lease in place and tenants were there, that would be considered physically occupied. If you had to give concessions or free rent on the front end of the lease, then your economic vacancy would be represented in the fact that if you gave 1 month free on a 12-month lease, you're only going to collect 11 out of 12 required payments because you're given 1 month away for free. In today's office market, though, you almost add a second component to the physical occupancy side, which is not just do you have a lease in place with a tenant, but how many of those tenants are actually showing up to the office. And so I think as CRE investors start underwriting these deals, it's almost like a physical occupancy. Of those spaces that have leases, how many physical representatives do they have at the space? Because that gives you some credibility to that underlying lease payment. They're still making them. We haven't seen a huge amount of distress in the marketplace yet, but I think that's something that we should keep an eye on going forward. if people are actually not sending people to the office at some point, potentially people are going to start making those lease payments, at least in full, try to renegotiate.
And a related story on the office occupancy, you saw a lot of coverage of Jamie Dimon's comments in his letter to shareholders. Basically, remember how bullish he was? Everybody's got to go to the office 100%. We're all going in. Now, all of a sudden, it's not 100%. It's a little bit more like 50%. And in fact, it's hybrid. So he's acknowledged that they are going to a hybrid model. About half the people will be working in that model. Half will be in full time. And then there'll be another 10% that'll work from home full time. So just goes to show that even the banks that have been extremely focused on getting everyone to work had to modify their plan. They still, as everybody knows, they're moving to a new headquarters. They're going ahead with that, and that will house about 12 to 14,000 of their employees. So they still plan, obviously, to have a pretty big presence.
Yeah, I think the nugget to take away from his comments, Martha, were for every 100 employees, they maybe only need seats for 60 to 75 of them on average. So to your point, it's a pretty large shift from what he was saying at the front end of the pandemic.
Yeah. And so one update story, the story is taking us to Connecticut Charter Communications, which is a company that provides Spectrum branded services. If you're in that territory, they've sold their former downtown headquarters for $72 million. And this is an interesting story because it takes us back a couple of steps where this has been in TreppWire multiple times because this property has changed hands and tenants and has taken a loss.
Yeah, I mean, they sold it for 72, and that's down from 100 million that they paid for it in 2020. The property was packaged into a deal back in 2007 by Goldman Sachs, and there weren't any red flags at the time. But at that point, the property was valued at 335 million, and there was a 2016 appraisal that cut it down by 60% to 134 million. So every few years, basically, there was some bad news about the value of this property, and now we're seeing the latest of it.
This was another 2007 deal. So I think this is the third or fourth 2007 deal that we've talked about just today. And I would say this kind of highlights, when you have those single tenant campus type of buildings set up, if they vacate, which in this case they did, to a new headquarters, it's really hard to get those properties back up to market.
Yeah, I think originally UBS had significant presence, International Paper and American Express, and all of them, I believe, have relocated, which created, some significant vacancies in that building. So we're going to dive a little bit into single family rentals. It's an area that we've had a lot of questions about from a number of our listeners and clients. And in fact, we had client/listener/podcast guest on this past week, Matthew Osborne from Eastern Bank. And it is one of the areas that he's interested in getting some more information about. So we thought we'd spend a little time talking about this asset class and what we know about it so far.
Yeah, single family rentals are interesting because up until maybe the last 6 to 9 months, when you're talking about residential real estate, the hot property sector has been the short-term rentals, the Airbnb type of properties. What we've really seen though over the last, call it maybe even the last 12 months, is a concerted effort by institutional investors to really come into this space. And so I think this is a byproduct of a couple of things in the market. So the smart money has been priced out of the type of yields they require in some of the traditional asset classes. So as office prices and multifamily prices have continued to increase in primary markets, they've been forced to either go to secondary or tertiary locations, or in this case, potentially spin to a new type of asset class. So I think the narrative now is that single family rentals are quickly becoming a new CRE asset class on the whole. And so we have a few nuggets here to kind of throw out there. So it looks like John Burns Real Estate Consulting talked about the surge in build for rent homes. So they accounted for about 26% of properties added to these single family rental portfolios in the fourth quarter of 2021, compared to just 3% of their portfolios in third quarter of 19. Purchases of an existing individual homes by single family rental home providers during that time decreased from 81% to 57%. So what I've seen in the marketplace is actually new home developers building entire subdivisions from a build to rent perspective. And I think it makes sense. If I'm an investor looking to acquire 2,000 homes and I'm buying them one off, there's some challenges with scale in that type of transaction, because now I'm going to have to go and write 2,000 contracts. I'm going to have to do renovations on each of those individual properties and then try to lease those up. That eats into my margin. But if I can work closely with a new home construction builder or potentially do that myself, I can get the economy of scale benefits, probably even better than what I could in a multifamily environment. So I think this shift is indicative of what we would probably see over the next couple of years. The other thing is these types of properties provide amenities that apartments just can't provide. So if you're a family with children or family with pets, family with multiple cars, you get a garage, you get a backyard, you get a lot of things that you're just not going to get in a multifamily, traditional, conventional apartment complex.
Yeah, so issuance on the SFR deals has been actually quite intense. There's already 6.7 billion this year, a quarter into it. Last year, there was 18 billion, throughout the entire year, and 18 billion was the biggest year of all time. It's a rapidly growing space. On a percentage basis, it's outpacing, multifamily, of course. SFR also, there's the deals that we see, in Trepp data, and there's a lot of deals that are done privately, and a lot of lending that's done privately, right? There's a huge amount of lending that just goes right onto like an insurance company's balance sheet or something like that as well. So it's a huge space that's been growing drastically.
Yeah, if you're a single family rental investor, we have underlying collateral data in these deals that get issued that we track in our data set. So we'll actually know for each of these originations, the total number of properties included, the actual physical address of each asset, whether they were leased at the time of sale, what the perceived market rent is, and what the current rent in place is on those. So we have some really granular information that we could build some really good analytics on. I think if you look at the issuance over the last 3 years, Andrew mentioned we're already at about 6.7 billion in the first quarter of 22. Total issuance in 2020 for single family rentals in our data set was about 9.7 billion. In 2021, that exploded up to about 16.5 billion. But if you annualize this first quarter number, we're talking about $26.7 billion for 2022 if it keeps on this pace. So it'd be really significant, and I think just speaks to what we were talking about earlier in terms of how expansive this has come relative to what it was a few years ago.
And we are going to do a quick hit on hotels. We had a couple stories, but I'm going to focus on the West Palm Beach apartment that sold and is now converting to a hotel, which is an interesting story.
Yeah, so this is an interesting story. It's an 8-story apartment building in downtown West Palm Beach, sold for $84 million, and they're going to transition it from an apartment to a hotel. So for those that have listened the last couple of weeks, I think we talked about some micro apartments in North Carolina and a few other places, and we kind of chuckled and laughed about how willing are people to sacrifice apartment life into a 400 square foot unit. Lo and behold, this property comes on and sells, and the average unit size is 419 square feet. So the buyer on this deal was a joint venture between Plymouth Meeting, Pennsylvania-based Corman Communities, and North Palm Beach-based Electra Hospitality Group. I think what was a good takeaway here is that the brokers on the transaction actually highlighted that the hotel market in South Florida has rebounded to above pre-pandemic levels, and the transaction price is a testament to that. So what's interesting is when marketed as an apartment complex, it was generating offers in the $50 million range. They actually had one that was 65 million, was the high water mark to continue operations as an apartment. When they started marketing the deal as a potential conversion to hotel, as we mentioned, they were able to get about $84 million. So it's really interesting, just the market dynamics. And especially, I think, given where this is at in West Palm, that high-end luxury hotel probably is a longer term highest and best use for this property.
So turning to shout-outs, we have a few of our favorites. We had Dan M., who, if you listened to us last week, we talked a bit about the inverted yield curve, and Lonnie, in self-deprecating humor, made fun of the fact that he doesn't know what an inverted yield curve is. He thinks of Top Gun and the fighter jet pilot who's upside down, flipping the bird to the other flyer. So we got a picture of Lonnie's head superimposed on a GIF with, well, let's just say there's a bird in the picture. Calls you the Texas legend, and he said his brain also went to Top Gun when he heard about yield curves.
Yeah, I will say this: the nickname Texas Legend is pretty rock solid. So if you guys want to start referring to me as Texas Legend, I'm cool with that.
I think we'll have to do that. And speaking of Tommy C, if I didn't mention him, I should have. He's the one that sent us the note from Dan M. Wanted to mention that they're going to be at the NBA Tech Conference April 11th through the 14th. Our friends Mike Benz, Will Froling, and Tommy will be in Vegas. God knows what they'll do there. I know those guys will probably have a good time.
Hopefully what happens in Vegas stays in Vegas with those
allegedly, yeah. And a couple more. Scott B said in our episode last week that Matt Anderson on our pod was probably one of the best yet. So I don't know if we should be hurt by that, Lonnie, that it took Matt to get that kind of accolade from Scott, but I'm a little hurt.
Well done, Matt.
Well done, Matt. Two more. Markets Junkie on Twitter noted on our podcast that banks have specific niches. So they love the podcast. Thank you for doing that. And Susie S shared episode 130 that talked about interest rates. So apparently that was a favorite. And I know we've extended our welcome here beyond what we probably should have, guys. I did want to point out that it might not be an accident that today, I know we record Thursday to end the week, but today is National Beer Day. And it happens to fall on opening day for baseball, which I can't think is an accident, right? The most widely consumed adult beverage paired up with America's pastime. It seems kind of poetic.
I mean, I don't have any personal experience, but I always thought of baseball like war, hours of extreme boredom punctuated by seconds of like terror and heavy tension. And I mean, clearly beer is a great medicine for both boredom and tension. So
I think Lonnie's lost his mind over there.
I'm going to go drink a Shinerbach beer. That's all I'm going to say about that.
There we go. And hopefully Manus is having safe return from his travels, and he'll be back next week. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.